So yeah,
They're
this
going
actually
by your
came in
friend.
from Michael via email, and he says, "Just wondering what you guys think about the Honest company. Sounds like it might be a smart buy now. Also, thanks for the recent video. I was highly considering getting in Lucid Group, but not now after seeing your video. So that was a video that Brett did. So give yourself a pat on the back, Brett. Pat on the back, Brett. And so yeah, the Honest company here." HNST on the NASDAQ, currently trading at a price of about $7.30 and just under a $700 million market cap. And the company is a personal care company dedicated to creating clean and sustainably designed products. And its products include baby clothing, diapers, wipes, nursery bedding, products, skincare, and makeup. And like Ryan said, the company was co-founded by actress Jessica Alba and IPO'd at $16 per share in 2021, raising over $400 million. So since its IPO in 2021, the stock has really been in free fall as the company has been unable to generate any profitability. And, it really couldn't generate any positive cash flow until, 2023, which we'll look at. But recently, the stock is up almost 100% since the beginning of November, driven by the company's stronger Q3 2024 results, or they're at least trending in the right direction. So let's take a look at the financials here. So, first, looking longer term, we can see that revenue has had a positive trajectory and has grown since 2019 with a compound annual growth rate of about 10%. But again, operating income, net income, and cash flow from operations have essentially all been negative, with the exception of 2023, where cash flow was actually positive. But looking at the recent quarter of Q3 2024, which drove the stock price higher, revenue was up 15% to about 99.2 million and was driven by strength in baby products and its wipes portfolios. As well as they noted, tracked channel consumption for the company grew 9.3%, outperforming the comparative categories, which were down 2.4% in the same period. And consumption for the company's products at the company's largest digital customer increased about 19%. Adjusted EBITDA was positive, 7 million compared to a loss of 1 million for the same period last year. And this actually represents the company's fourth consecutive quarter of positive adjusted EBITDA. So you can see they're just starting to post positive adjusted EBITDA. But again, this is adjusted EBITDA. And net income was a gain of 165,000 compared to a loss of 8 million for the same period last year. So, although the company has been losing money, it appears the profitability is at least trending in the right direction, which is good to see, but it's still pretty early here. As well, driving the stock price, the company actually increased its full year 2024 outlook for both revenue and adjusted EBITDA, increasing its revenue outlook to be in the high single-digit percentage growth, and adjusted EBITDA now up to a range of 20 to 22 million. And looking at the forward valuation using the midpoint of the adjusted EBITDA multiple or adjusted EBITDA, this places the stock at an EV to or enterprise value to EBITDA multiple of about 31 times, which is not cheap in my opinion. And on a trailing basis, it trades at about 25 times trailing cash flow. Now, looking at the balance sheet, it remains quite healthy with cash of about 53.4 million, no debt. They just have leases, and they have a net cash position of 38 million. But we can see that the company's share count has been creeping up steadily as the company struggled to generate profitability. And just an operational update here. In 2023, the company executed on a broad-based transformation initiative designed to drive growth in higher margin areas and strengthen the company's cost structure to increase margins. And this includes things like focusing resources on North America, which includes the exit of its low-margin business in Europe and Asia, exiting low-margin elements of the cleaning and sanitization business in 2023, executing an inventory rationalization program in 2023, redirecting resources to accelerate cost savings, etc., as well as realigning resources to reflect the prioritization of higher margin opportunities. And we can see that there's actually been some progress on margins, which is, of course, a positive if the company is going to begin to generate more meaningful profitability in the future. But just keep in mind, I'll say this in the conclusion as well, over the last 9 months of this year, adjusted EBITDA margin was only 6% or just under 7%. So still quite small. And again, that's adjusted EBITDA. So keep that in mind. Now, management noted in their most recent quarterly conference call, as we look ahead, we believe we have strengthened our foundation for future growth and expect the ongoing execution of our strategy to deliver annual revenue growth, expand profit margins, and generate strong cash flow, which also benefits from our asset-light business model. So it's nice that they're putting emphasis on wanting to generate, stronger cash flow. Um, and they also noted that annual gross margin is expected in the range of 37 to 38% as they benefit from savings in product costs and supply chain efficiencies. So again, it's good that they're focusing on the bottom line. So to conclude here, the Honest Company is in highly competitive markets with over 60% of its revenue coming from diapers and wipes. But these are consumer staples, essentially, which are more defensive. But still, they're against behemoths in these segments. And consumer products can, sometimes be fickle with customers, depending on, tastes and preferences. Now, the company has a good track record of producing high single-digit revenue growth and is now moving more focus on increasing margins, which appears to be paying off. The stock may be a bit pricey at 30 times forward EBITDA and 25 times 12 trailing month cash flow from operations, but I see some speculative upside if management can continue to increase margins. And overall, though, it's not a bad business, in my opinion. It has potential, but it's just a little early for us, as we would like to see continued ability to massage margins higher to generate more meaningful profitability. And again, like I said previously, they only did adjusted EBITDA margins of 6% over the first 9 months of the year. So while it's good that 4 consecutive quarters of adjusted EBITDA, again, this is only adjusted EBITDA. Um, you know, the margins are still quite slim.
Yeah, I would say based on even forward EV to EBITDA estimates, which would be optimistic, the company trades at about 3 times the sector average. And it is a highly competitive sector. It's, our price to book, price to sales. It's above price to book significantly, price to sales above the average. So a company that, I mean, it's growing reasonably well, but it's not growing at 50% or anything like that. It's not like growing at 30,
Exactly.
50%. So I think you're taking on too much risk, and the company isn't yet profitable. So you're forecasting forward that it will be profitable. And even on those estimates going forward on an adjusted basis, it's like 3 times the sector average. So you're taking on a lot of risk. And the reason there is a good balance sheet is because of raising capital, not because of internally generated cash flow. So, yeah.